All right, I think we're live. Well, welcome everyone to DLA Markets. We are going to do something very exciting today. For the first time on this channel, I am going to do a live interview. Well, it's not really going to be live, it's going to be pre recorded, okay? But we're going to start doing interviews on the channel. And for the first interview, we're going to follow the same topic that we followed over the last couple of videos, which is basically talking about interest rates, talking about Fed policy, and specifically talking about commercial real estate. Okay. And for this interview, I have a commercial real estate finance expert who I have known for many years, and he is going to come on and we are going to have a discussion about the current state of commercial real estate, the financing markets, and it's going to be very interesting. So with that, let me introduce Alex. Hey Alex, how
Hey,
you doing?
hey everybody. Hey Greg. Good to see you again.
All right. Well, Alex and I have known each other for quite a few years. We originally met at the karate studio where we're both masters. And then Alex, for a bunch of years, was actually my banker when I had my own real estate company. And so we did a lot of deals together in that context. And then we also worked together at JP Morgan for a number of years. And now we are still involved in the real estate business and the financing business at a different firm. But Alex has been in the business for many years, so I thought it would be a great and very interesting conversation to bring him on. So, how you doing today, Alex?
Good, good. Thanks for having me, Greg. I love your
Okay.
channel.
Oh,
I'm one of your
thank you.
first
Thank.
subscribers.
That's right. That's right. That's right. That's right.
So,
So,
so
Alex, why don't
yeah.
you? Yeah, let's start out by why don't you just introduce yourself and let people know basically what your experience is and what you've been doing for the last 25 years.
All right. So I started out my career as an architect, believe it or not, and I got a Bachelor of Architecture degree and worked as an architect and um, did that for about 10 years. Then went to business school, got an MBA,
Mhm.
and thought for sure I was going to go into real estate development, but then got an offer from Solomon Brothers and went to Wall Street and never looked back.
Ah, there
So
you go.
yeah, so that's how it started in the beginning. I worked in the structured finance group at Solomon Brothers for a number of years and went through all the mergers with Sandy Weil at Citigroup. Um, did that for a number of years. Then been in all kinds of real estate lending since then. I've done CMBS, commercial mortgage-backed securities, done some commercial banking over the years during the dark days of 2009, 2010. And then went to JP Morgan and now still doing structured finance at different firms. So it's been
Okay,
a
great.
long road at many different lenders.
Yeah, we have very similar backgrounds, but substitute DLJ, Donaldson, Lufkin, and Jet with Solomon Brothers, and you have uh,
Yeah.
pretty much my background. So Alex, I think it would be helpful to the viewers if at this point you sort of talked about the current state of the commercial real estate business, particularly the financing side, and how we got to this point, and just sort of lay it out for us, and we'll take it from there.
Sure. So, just to give your listeners a little bit of background, um, the commercial real estate finance business is basically broken up into two different types of lending. There's permanent lending, um, which is 10 years plus lending, amortizing debt with a balloon payment at the end of 10 years. Typically things that banks offer, very similar to your home mortgage, except with your home mortgage, if you have a 30-year home mortgage, it's a 30-year amortization schedule. So by the end of the loan term, there's a zero balance. With commercial real estate, you usually have like a 10-year loan term with a 25 or 30-year amortization schedule. So at the end of the loan term, there's a balloon payment that needs to be made. And typically
Right.
that balloon payment is satisfied either with a sale of the property or with a refinance of the property, right? So that's what
Right.
we call the permanent lending side. The other side of the business is the bridge loan side. And with bridge loans are basically the lenders are financing the borrower's business plan. So, for example, a borrower may buy a property that needs lease up, it needs capex work, it needs to be repositioned basically for one reason or another. So the borrower will come to a lender with a business plan basically saying, I need money to buy the property, I need money to fix it up, and then I need money to get new tenants in. So the way that we look at those kinds of loans is we will provide them a certain advance rate or leverage level for the purchase, say 65% of the purchase price. And then we will advance them in the form of future funded facilities, CapEx money to fix up the property, tenant improvement money to get the tenants in, and leasing commissions to pay the leasing brokers. So it's much
Hmm.
more of a business plan style lending. Now,
Right.
because it's a much more riskier style of lending, it's priced differently than a permanent loan. A permanent loan will be some spread over the treasuries, the 10-year treasury, the 5-year treasury, whatever the loan term is. And the bridge loans will be priced as a spread over SOFR, um, which is a floating rate index. So right now, permanent loans will be, 6, 7%. Bridge loans will be 8, 9, 10%, given the
Right.
current state of interest rates in the indexes in the environment today.
Yeah. So with the Fed raising interest rates, and we talked a lot about this on the channel, um, in excess of 500 basis points over the last year, what effect has that had on the financing market and also the real estate values out there?
So one of the things that your readers, your listeners need to understand is that a lot of the deals that we're looking at now, especially deals that are being refinanced, not purchases, not being purchased new by a borrower, but being refinanced where the borrowers have owned them for a while, were purchased under a completely different interest rate environment, right?
Right.
So therefore, all of the values based on today's interest rates are overstated. So let me give you an example. So let's say you bought an apartment building, um, I don't know, in 2020 or 2019, right
Right.
before COVID, right?
Yeah.
Typically, those properties, you would buy those properties at like a 3.5 or 4 cap rate. Now, the cap rate is the return that the borrower gets on his investment or the buyer gets on his investment. So, a cap rate, the simplest way to look at it, it's the cash flow that the property throws off divided by what they paid for the property, right? So
Right.
that's the initial return, the going in return that the borrower gets,
And
right?
that valuation is based on the prevailing interest rates at the time.
Correct, because
Right.
the more that you can borrow, the more you can pay, right? It's
Right.
like that in the home mortgage market too. It's like you see now that interest rates are so much higher, housing prices are starting to come down because people just can't afford, to borrow the same amount of debt because the monthly payment is so much higher, right?
Right.
So it's the same thing in commercial real estate. In commercial real estate, these properties were valued based on interest rates basically at zero, right?
Hmm.
So there's a certain valuation associated with that. There's a certain amount of money you can borrow when interest rates are so low. And because you can borrow a certain amount of money at lower interest rates, the prices of the properties can be so much higher because the amount of money you can borrow can be so much higher. But because the interest rate is so much lower, the monthly payment is lower.
Right.
So the amount of cash flow that's available to service the debt is high, right?
Right.
So it's a little bit confusing from that perspective. But you have to look at it the same way that you look at a home mortgage. You have to look at it is what is the money that's available after all the expenses to service the debt, right?
Right.
Now, lenders will typically want a multiple of the cash flow to be able to service the debt, like, of 1.225 times, 1.3 times, 1.5 times. And based on those different debt service coverage levels, we call them, um, the lenders have a certain level, they have a safety margin, right? And because lenders want to continue to have those safety margins, interest rate payments have gone so much higher,
Right.
right? So it basically means that the cash flow available to service that debt has to be higher, right? So to make the cash flow available to service the debt higher, you have to have a lower loan amount.
So you can be
So
in a situation where you're a property owner and you're fully occupied, whether it be multifamily or retail or whatever. You can be fully occupied. Your cash flow could be the same or higher as 2019, but because interest rates are so much higher and cap rates are so much higher, the value of your property has gone down.
correct, correct.
Right.
And it's merely a paper function, right? Because assuming that the economy is strong and your rent roll still generates the same rents that it was generating, in the previous interest rate environment,
Right.
the fundamentals of your property are the same. It's just from a financial perspective, it's worth less because when you go to sell it or you go to refinance it, the cost of the debt is so much higher that you're not going to get the same either price or same loan amount that you would have gotten before, because of the way that the interest rates affect what people are willing to pay.
Right.
Now,
So this
maybe that's something that we should talk about a little bit. How interest rates affect what people are willing to pay for something, right?
Okay, but before we do that, let's talk about without getting too in the weeds on uh, property specifically. Let's talk about so obviously this has affected the banking system, right? Because all of a sudden mortgages that banks have held on their balance sheets and other lenders have, even if the cash flows have remained the same, which in many cases they haven't, they've gone down. But even in properties where they stayed the same, the values have come down. So the values of these mortgages on their balance sheet has gone down, and that has really affected the banking system, right? So let's talk a little bit about that. What are you seeing in the market? You know, I know from being in the business that banks were very aggressive on the way up. What are you seeing now that we're on the way down? Are you seeing a lot less competition among banks? I mean, what are you seeing in terms of competition and also deal volume?
Well, the banks were an enormous player before this banking crisis happened. With the failures of Silicon Valley Bank, you know, Signature
Signature,
Bank, First Republic, among
right?
others. They were very active. They were probably, at least in the markets that I lend in, New York City, the Northeast, were extremely active. Um, because they had the lowest cost of capital, quite frankly, because they were able to borrow from the government at like zero and their deposits they paid out at zero. So they had the lowest cost of capital on the street and they were able to do short term money, right? But once this banking crisis hit and interest rates started to rise, all of a sudden, these huge real estate portfolios that these people had, these banks had on their balance sheets, started to become underwater when you started to revalue
Right.
them every year, right?
Yeah.
Because the cap rates were just getting higher and higher as interest rates went higher and higher. So that in itself caused the banks to pull way back, right? Because they started to have problem assets on their balance sheet. Now, albeit not all of these loans were defaulting, right? Some of them were paying, some of them were still
Right.
paying, and they were fine.
Right.
But from a valuation perspective, they were underwater. So
Right.
that in itself caused the banks to pull back dramatically. So what we've seen is a systemic shift away from bank lending to private lending because
Right.
private lenders don't have the same regulatory restrictions that banks have, right? Now,
Right.
banks, even it started in 2008 where the large banks were regulated and they had to hold more capital against loans. Now,
Hmm.
even the smaller regional banks are being forced to hold more capital against loans. That's making it more expensive for them to make loans. That, coupled
Right.
with the problems that they're having on their balance sheets, have caused banks to pull way back, way back.
Yeah, and let me just interject something. Jamie Dimon a couple days ago, the CEO of J.P. Morgan, said that the government, as a response to SVB and Signature and other banks failing, is they're now increasing regulation on the banks and increasing capital requirements, which is further going to restrict credit. And he was really hot under the collar and disagreed with that because he thought that it wasn't really that we don't have enough regulation; it was just that the regulators basically failed in their job to regulate the bank's property. And of course, the managements of these banks were completely inept and incompetent. And that's really why they failed. We don't need necessarily more regulation or more capital requirements. But I just wanted to put that in there because
No,
that just
yeah, and
came out a
you're
couple days ago.
absolutely right. You're absolutely right, and Jamie Dimon's absolutely right with this systemic shift away from banks to private lending right now. Whether that holds into the future, who knows? But that's what's happening right now, for
Hmm.
sure. Um,
So let me ask you this: and we've done some content on this channel about this, but let me ask you this question: there's about $2.8 trillion of loans out there on the balance sheets of banks and private lenders, CMBS, the whole thing. Many of those loans are coming due in the next 3 years, 2 to 3 years. What do you see happening when all that happens?
well, unfortunately for these borrowers, um, they're going to have to be some quite extensive basis resets on these deals.
Mm,
And the reason why I say that is, especially if you were in the banking market or you were in the CMBS market, there's a lot of interest only that was associated with these loans, right?
right,
So there was
right.
no amortization. So these loans that are coming due um, are the same loan balance that they were 10 years ago, right?
Mm,
When interest rates were zero. So
right.
if you made a loan 10 years ago in a zero interest rate environment and the property was worth $70 million back then, you know, when the Fed funds target is, between five and a quarter and five and a half, there's no way mathematically that those properties can be worth $70 million today. There's just no
Yep.
way, right? So a lot of these borrowers are going to have to bring money to the table in
Mm,
order to refinance these loans. So it's what we call in the business a basis reset, as I said
right,
earlier.
right, right.
These borrowers are going to have to inject a lot more equity into these properties in order for them to basically get out of the loans that they already have.
Mm,
Or they, if they sell, they may have to sell at a much lower price than they thought that they would get after
yeah.
they implemented a business plan or what have you. So in some cases, their equity is worthless or worth a lot less than they had originally thought it was worth.
Mm-hmm.
And
Mm-hmm.
that's what we're seeing, even in the loans that we're doing right now. We will not do a refinance without the borrower recommitting to the property in one way or another, whether it's cash or guarantees or something,
Yeah.
because the metrics are just not there like they were, 5, 7, 10 years ago.
Yeah, and when you're in a situation with limited partners, the last thing in the world a limited partner wants to do is cough up more money to a deal that's going down in value. So that's where
Right.
that's why you actually see in these kinds of situations a lot of people just giving their property back to the lender, either through involuntarily through foreclosure or voluntarily by just a deed in lieu, giving the keys back. And we've seen Brookfield, and we've seen um, Blackstone, and some large institutional investors doing that. In many cases with some of these office properties in these larger um, metropolitan areas like New York.
Right. In the latest issue of Commercial Mortgage Alert, which is one of the industry magazines that we read just to keep a handle on what's going on in the market, there's a very unique phenomenon that's happening now where borrowers, especially in office properties, where a borrower, where their equity is worthless, right? They have no
Right.
more equity in the deal. But, you know, they're not at the point where they're just going to give the keys back to the borrower, to the lender, right? Because they do believe in the property. They do feel that the property has value, and there were reasons why they purchased the property to begin with, and those reasons probably haven't changed, right?
Right.
It's just the financing environment has changed dramatically. So a lot of these borrowers, they're not going to put any more money in. They don't want to put any more money in. So there's a
Right.
phenomenon that's happening now where the borrowers are going to the lender and they say, I have this tenant that wants to come in. It's an office tenant. It's going to cost $1 million to put them in. Here's the lease. If you want to put them in, you have to pay for the leasing commissions and the tenant improvements, right? It's something that
It's a
I've
nice
never seen.
conversation.
Yeah, it's something that I've never seen happen, but it's a way that the borrowers are basically throwing up their hands and saying, look, we're in this together. And, you know, if you don't want me to give the keys back to you, if you want me to keep managing this property, you know, you're going to have to, you know, step up a little bit here. Now, I don't know
Right.
how successful that's going to be. You know, maybe on some of these, $100 million, you know, properties, maybe that makes sense. But,
Right.
you know, for the run of the mill property, there's no way a lender is going to start ponying up more loan proceeds just to bail the borrower out of a bad situation.
Yeah. Well, one of the things that I know we've discussed in the past that I wanted to bring up before we wrap it up, we're probably going to wrap it up in a few minutes, but one of the very, I think, interesting topics is the topic of government intervention in both the banking sector and in, the economy writ large. And when I look at that, it makes predicting the future or seeing where the opportunities might be in the commercial real estate sector really difficult to predict because you never know what the government's going to do. I mean, look at SVB and Signature and some of the others. The government stepped in quite quickly and maybe not did a they maybe not did a complete bailout, but they facilitated either a private bailout or they provided lending facilities. They do anything they possibly can to make it so that these banks do not fail and basically that nobody fails. So, I mean, where do you think we're going with this, given the fact that the government seems so intent on, softening the blow and not letting anybody really fail anymore in
Well,
capitalism?
I think this is a generational shift, right? You know,
Yeah,
we've kind of talked about it, personally, the two of us.
yeah,
Um, the government has become so comfortable intervening and manipulating the markets,
yes,
that I don't think that philosophy is going to change. And this has been going on since 2001, since 9/11, when the
right,
towers came down under George Bush.
yep,
Um, the government has felt the need to intervene dramatically into the free operation of the capital markets, right? You saw it with quantitative easing, the
hmm,
Federal Reserve's program to buy illiquid securities from the capital
right,
markets in order to keep the
yep,
markets open back in
yep,
2008, 2009.
right,
Well, quantitative easing over the intervening years never stopped. They just
right,
kept doing it and kept doing it, and they kept providing more and more liquidity into the market. So
yep,
anytime an issuer, made a bet and the bond offering went south, the government just kind of stepped in and bought it, at whatever discount or whatever basis they bought it at, just to maintain liquidity in the marketplace. And
right,
pumping that kind of money into the system on a consistent basis created a certain environment of total liquidity. There was
mm,
no liquidity shortage.
right,
So I remember back in those days, the people that basically ran the market were the people that had the deal. It's
right,
like you could get the money anywhere.
yes,
The
right,
fact that you had money didn't mean anything. It was just a
exactly.
commodity. It
That was
was
the
the
commodity. Yeah,
deal. It was the deal that was the unique attribute.
Yep.
So, I think that the government is going to continue to do that because the government has basically created um, an economic environment where it's expected. It's
Right.
expected by the market participants that if there's a problem, the government is going to step in and fix it.
Yep.
So I don't see the economy actually functioning the same way we learned about it in business school. You
Mm.
know, there is no freedom in the markets for people who make bad decisions to fail
Yep.
because the government will just step in and solve the problem in one way or another. Now, and the reason why I don't think it's going to stop is because it's become politically expedient for the politicians to do this, right?
Sure.
Nobody wants to be um, uh, nobody wants to be in the driver's seat during a deep recession, right?
Right.
Nobody does.
Right.
So whatever the politicians need to do to keep the country out of recession, they're going to do it. Whatever the politicians need to do to maintain the integrity of the banking system, they're going to do it.
Right.
Whatever the politicians need to do to not look bad when it comes time to get reelected from an economic perspective, they're going to do it because it's not
Right.
their money. It's not their money. They're just manipulating monetary policy with the Fed in terms of interest rates and quantitative easing and increasing the size of the Fed balance sheet. And from a fiscal perspective, the Congress is just, they're just a drunk spendthrift where they just keep spending and spending and spending. And you see it with the amount of money being pumped into the economy right now as a result
Right.
of the Trump era and the Biden era, COVID stimulus policies.
Yeah.
So I don't see it ending anytime soon. And I
Yeah.
don't
And
even see
with
how you could unwind it.
yeah, and with that $5 trillion of money coming in just since Biden took over, along with the Fed staying in the money printing market and keeping interest rates at zero for too long after the economy was already recovering from COVID, you've created an asset bubble and an increase in valuations that's now unwinding. But the thing is, the problem that I have with Powell, for example, at the Fed, and I've said this a number of times on the channel, is that um, it always comes out as being too little, too late. They're dribbling in these quarter point increases after large increases, admittedly, and now they're in quantitative tightening where they're reducing the balance sheet. But by dribbling in these small increases and being data dependent, in other words, not being in the driver's seat and setting the tenor of what they're doing, just reacting to data, I think they're going to create a situation, again, with all this money coming in from the government, where interest rates are going to stay higher for longer. And I've noticed, and I think you have too, that a lot of the borrowers out there, not only commercial real estate, but just in general, think that rates are coming down, and consensus is that we're going to have a soft landing. And uh, pretty soon after that, the Fed's going to start lowering rates. I think they're going to stay higher for longer than most people think. And I think that's going to precipitate eventually a pretty severe recession, because the only way to get unemployment up, in other words, a weakening in the employment picture and a weakening of the spending that we're seeing that's causing all this economic strength and driving up inflation, is to really crush the economy. And I don't see, again, going along to what you just said, where the government is so intent on not disturbing things and not being the bad guy. I think because of that, Powell's not doing enough, and as a result, it's just going to prolong things longer, because he doesn't want to be responsible for putting 3 million people out of work, right? Nobody wants
No,
to be that
no.
guy, right?
Yeah. No, and I agree. But I do think there's a way out for Powell, right? And it's something that not a lot of people are talking about. And I think the way out for him is to revisit this 2% inflation number. right?
Mm-hmm.
Because the 2% inflation number is an arbitrary number, right?
Mm-hmm.
Nothing in the financial markets is ever modeled at 2% growth, right?
Right.
Nothing,
Mm-hmm.
right? Everyone is modeling 3% growth, 4% growth, 5% growth in all forward-looking projections. So why Powell feels is so fixated on this 2% number, which I know is the Fed policy number, and it's been the Fed policy number forever, right?
Right.
But it's been the Fed policy number when the markets were able to freely function. Now
Yeah.
that the
Right.
markets are being constantly manipulated by either the Federal Reserve or congressional spending, um, maybe a 3% inflation target number is the right number. Why 2%? Maybe 3%.
Right.
And these are the kinds of things that I think Powell needs to start thinking about if he
Mm.
wants to get himself out of this without having to completely destroy the economy,
The economy.
put
Yeah.
people out of work, and do all this stuff. I think there are other ways. Now, I'm not an economist by any means, but I do think that a 2% inflation target is pretty aggressive,
Yeah.
you know.
Yeah. Well, I think this is probably a good place to wrap it up. We've had a very interesting discussion, and I want to thank you for coming on short notice and being willing to do this with me. I think you presented some very interesting viewpoints, and I'm sure my subscribers and others that are seeing this got a lot of value out of it. And by the way, if you did get a lot of value out of it, please like and subscribe. And Alex, I want to thank you again for coming on. And thank you for everyone watching. And with that, I think we'll wrap it up. Okay?
All
Thanks,
right.
Alex.
Thanks, Greg. Thank you so much.